Welcome to Blind Trust. In 1998, the smartest men on Wall Street ran out of money, and the Fed decided the financial system might collapse with them. The fund at the center of it had two Nobel Prize winners on its board, a former vice chairman of the Fed and the most feared bond trader of his generation. It had turned $4 billion of its own into positions worth over $100 billion. 4 months earlier, it had been the envy of the street. Then one country on the other side of the world did something the models said was almost impossible, and in 15 weeks, that envy was worth nothing. This is the story of how genius went bankrupt, and who really got saved when it did. To understand what happened in that room at the Fed, you have to go back 4 years to a man named John Meriwether. In the 1980s, Meriwether ran the bond arbitrage desk at Salomon Brothers, and for a while, it was the most profitable trading operation on Wall Street. He hired physicists and mathematicians when everyone else was hiring salesmen. He believed that markets, underneath the noise, obeyed rules you could measure. In 1991, he left Salomon under a cloud. One of his traders had been caught lying to the United States Treasury, and Meriwether had known and been slow to report it. But his reputation as the smartest man in bonds survived it intact. So in 1994, he built his own fund. He called it Long-Term Capital Management, and he assembled a board that no one on Wall Street could argue with. There was Black-Scholes and Robert Merton, the two economists whose formula for pricing options had rewritten modern finance. There was David Mullins, who had just stepped down as vice chairman of the Federal Reserve. Nobel level theory, central bank credibility, and the best bond traders alive, all in one building in Greenwich, Connecticut. Investors handed them over $1 billion to start, the largest hedge fund launch in history. The minimum to get in was $10 million, and you couldn't take a cent out for 3 years. They were turning people away, and they hadn't made a single trade yet. So what did they actually do with the money? This is the part that matters because it is the part almost no one explains. Picture two bonds. They're nearly identical. Same borrower, same promise to pay you back. Except one was issued last week and one was issued 5 years ago. The newer one is easier to buy and sell, so people pay a tiny bit more for it. A few pennies on the dollar. But both bonds come due on the same day for the same amount. So that tiny gap between them has to close. It isn't a guess. It is arithmetic. Eventually, they become the same price. Long-term capital's whole idea was to find thousands of these tiny, almost certain gaps all over the world and bet that every one of them would close. There was only one problem. The gap was tiny. If you put $1 into a trade that only moves a penny, you make a penny. That is a terrible return. So to turn a penny into a fortune, you don't bet $1. You bet 100. You borrow the other 99. This is leverage, and long-term capital used it like no one ever had. For every dollar of its own money, it borrowed more than 25. On paper, that sounds insane. But the trades were so safe, so mathematically certain to converge, that 25-1 felt conservative. And the banks lining up to lend them the money agreed. The question is why? Wall Street had seen smart traders before. What it had never seen was a trading desk with two Nobel laureates sitting on it. When Scholes or Merton walked into a bank to negotiate terms, they weren't just borrowers. They were the men who had invented the language the bank itself used to measure risk. In October 1997, that credibility reached its peak. Scholes and Merton were awarded the Nobel Prize in Economic Sciences. Here is how the announcement sounded.
I haven't thought about it yet in all this excitement, but I really don't know what I would do with it, but it's certainly very collective.
The committee said their work had laid the foundation for the entire modern market in derivatives. Officially, they were now the smartest men in the room, and the numbers seemed to prove it. In its first full year, the fund returned 43% to its investors. The next year, 40%. Even after fees, and the fees were enormous, far above the industry standard. Investors were nearly doubling their money in trades that were supposed to be almost risk-free. The fund grew to control positions worth over $100 billion. Banks gave them terms no one else could get, sometimes lending with almost no collateral at all, because who was going to doubt a Nobel Prize? That was the real product. Not the models, the certainty. And Wall Street was buying it by the billion. By the end of 1997, long-term capital had a problem most funds would kill for. It had too much money. The tiny gaps it hunted were only ever so big. And with billions still pouring in, there simply wasn't room to put it all to work at the returns investors had come to expect. So they did something that sounds responsible and was actually the beginning of the end. They handed money back. $2.7 billion returned to outside investors at the close of 1997, but they did not shrink the trades. They kept the same $100 billion book of positions, now supported by less of their own money underneath it. Quietly, without placing a single new bet, their leverage climbed. The cushion got thinner, and the partners went further. They borrowed money to keep their own cash in the fund, because they were certain. If the trades were this safe, why would you ever want less of them? Then, in the summer of 1998, a warning light came on. Salomon Brothers, Meriwether's old firm, shut down the exact kind of arbitrage desk long-term capital was built on. And when a giant starts dumping the same trades you own, the prices you are counting on begin to move the wrong way. It was a small tremor. Nobody in Greenwich thought it was the earthquake. On the 17th of August, 1998, Russia did something that was not supposed to happen. It defaulted on its own debt printed in its own currency. Money it could, in theory, simply print more of. Governments don't default on money they can print. The models barely left room for it. What happened next is the single most important idea in this entire story. When investors around the world got frightened, they did not behave the way the model said they would. They all did the same thing, at the same time. They ran for safety, United States treasuries, cash, and they sold everything else. Everywhere at once. Long-term capital's genius rested on one assumption, that its thousands of little bets were unrelated. A bond spread in Italy had nothing to do with a mortgage bet in Denmark, which had nothing to do with a stock deal in New York, so if one went wrong, the others would hold it up. Diversification was the safety net. In the panic after Russia, that assumption died. Every unrelated trade suddenly moved together. All of them. In the wrong direction. The gaps that were supposed to close, converging like arithmetic, blew wide open instead. Everyone. At the same moment, the safety net wasn't just gone, it had turned into a rope, tying every falling weight to every other one. And now the leverage that had made them gods turned on them. When you owe $25 for every single one you own, a small loss is not small. A 4% move against your positions can erase the entire fund. In a single day that August, it reportedly lost $550 million. By the end of that month, it was down 44% in 1 month. The $4.7 billion of capital it had started the year with was more than cut in half. Here is the trap. Their trades were, in the long run, probably right. Those gaps really would have closed, eventually. But leverage does not give you the long run. Every day the market moved against them, the banks that had lent them 99 cents on the dollar demanded more collateral. To raise it, they had to sell. And when you are forced to sell the very positions everyone knows are drowning, you push the price down further against yourself. This is the thing about leverage that the equations left out. It does not create the risk. It removes the one thing you need to survive being early. Time. They could be proven right in a year. They did not have a week. Now the panic left Greenwich and arrived on Wall Street because long-term capital did not owe money to a few banks. It owed money to nearly all of them. More than 75 firms were its creditors or its trading partners. And among them was almost every major bank on Wall Street. If the fund collapsed, every one of those banks would have to seize its collateral and sell into a market that was already falling. The same drowning positions dumped by everyone. At once, the exact death spiral now multiplied across the entire system. First, the private sector tried to solve it privately. Warren Buffett, together with Goldman Sachs and the insurer AIG, made an offer to buy the fund outright. Buffett had watched this kind of leverage for years, and here is what he thought of it.
But To make money they didn't have and didn't need, they risked what they did have and did need. And that's foolish. That is just plain foolish. It doesn't make any difference what your IQ is. If you risk something that is important to you.
The offer was worth over $3.5 billion, but it was a one-page letter with a deadline of barely an hour. And by the time Meriwether's lawyers finished reading it, it had expired. So on the 23rd of September, 1998, the president of the Federal Reserve Bank of New York, William McDonough, did something the Fed almost never does. He called the heads of 14 banks into one room at the New York Fed and told them they were going to fix this together. There was no law that could force them. McDonough did not offer a single dollar of government money. He offered them a mirror, held up to what would happen to each of them if the fund went down. By the end of the meeting, 14 banks had agreed to put in $3.6 billion of their own and take over 90% of the fund. 2 banks refused to join, among them Bear Stearns, which had cleared long-term capitals trades for years and would not give a cent. That refusal would be remembered 10 years later when Bear Stearns needed saving of its own. The papers called it a bailout, and for 25 years, that is how it has been remembered. The Fed rode in and rescued a hedge fund full of billionaires. But look closer, because this gets it almost exactly backwards. The partners of long-term capital were not saved. They were wiped out. The men who ran it lost around $1.9 billion of their own money. Very nearly everything they had. Meriwether, Scholes, Merton. Their personal fortunes went down with the fund, and the Federal Reserve did not spend a single public dollar. Its own chairman had to explain to Congress exactly why the Fed had gotten involved at all.
It was the Federal Reserve Bank's judgment that it was to the advantage of all parties, including the creditors and other market participants, to engender, if at all possible, an orderly resolution rather than let the firm go into disorderly fire sale liquidation following a set of cascading cross defaults.
The Fed's whole reason for being in that room was fear. Not fear for the fund, fear of what its failure would do to everyone attached to it. So what did the Fed actually save? Not long-term capital. It saved the 14 banks in that room, and the dozens more standing behind them, from having to record those same losses on their own books. All on the very same day. Long-term capital was never the bomb. It was only the fuse. The bomb was the web of everyone who was quietly standing on the same trades. The fund was quietly wound down by early 2000. The banks got most of their money back, and on Wall Street everyone agreed it had been a near miss. A lesson learned, except almost nothing changed. John Meriwether opened a brand new fund the very next year, running nearly the same strategy. It lasted until 2009, when a far bigger crisis finally closed that one too. And the faith in the math never really broke. Years later, Robert Merton would still describe risk the same way, as a set of tools you simply had to balance.
The application of insurance, a newer, less widely used, but I believe is going to be more and more important. And why only use 2 tools when you have 3?
That was always the promise, that with enough tools, enough math, the danger could be managed. But long-term capital was not really an accident. It was a rehearsal. 10 years before the phrase, "too big to fail" entered every household, the Federal Reserve had already decided, in a single conference room, that some institutions were too tangled together to be allowed to fall. In 1998, it was $3.5 billion in one fund. In 2008, it would be trillions, and the whole banking system. And the argument, the fear, the logic in that room would be exactly the same. The lesson most people took from long-term capital was that the geniuses got arrogant, that they trusted their models too much. And that is true, but it misses the sharper point. They were never really selling a model. They were selling certainty, 2 Nobel Prizes, and a former central banker that made the entire world comfortable handing them $100 billion. And certainty, leveraged 25 to 1, is not safe. It is the most dangerous thing on Wall Street, because the more sure everyone is, the more they will lend and the less room is left for the market to simply be right. In the end, a little too late. So here is the question worth sitting with. The men in this story were, by every measure, the smartest people in the room. If certainty at that level can go to 0 in 15 weeks, what should you make of anyone who tells you today that something is guaranteed